Very good afternoon, good morning. Welcome to the FX Week Ahead live market analysis with myself, Giles Coghlan. I do hope everybody is doing well. Very good morning, good afternoon, Gavin, Ignatius, Kingsley. Good to have you here. Stuart, just as other folks are coming into the webinar, don't forget, as we look at different entries, exits, this isn't a signal trading service. The whole idea of this HYCM online look ahead webinar is from an educational perspective, as you look over my shoulder and see what I'm looking at for the week ahead. And some of the big things we'll be looking at is global stocks. We're going to be looking at the reaction to the CPI print that we're expecting this coming week, key drivers for the US dollar, also looking at what's dragging down the pound, why we might see a little bit more downside in the pound at the moment, dollar, yen, gold, silver, as well as looking at some things for the US midterm elections. So we have got an awful lot to cover during this session. So without further ado, I want to get stuck into the session as soon as I can. If you can just let me know you can see my screen and hear my voice okay, that would be great. And just take a quick look around markets as we look at the sentiment. But the sentiment is broadly positive as we start the session today. I'll just run through that in a minute, what it is, and that's partly to do with the US midterms just driving things. Yeah, thank you, Gavin. That's excellent. Yeah, excellent. Now, if we look at stocks, we can see that global indices are broadly pushing higher. China's 50 index pushed higher at the end of last week, if you remember, on the news that perhaps there's going to be a pivot from China regarding that China COVID policy, which is that strict policy, and they shut down large cities, large conurbations on comparatively small numbers of COVID cases. That's in part due to a weaker hospital infrastructure in China. It's also in due part to a weaker vaccination program for the elderly. So China's more vulnerable to COVID spreads than in the West, where we're highly vaccinated, lots of older people, and many Western nations are moving again much more freely. And, you know, nice for me to see the calendar. There's some more normal events coming up for the UK as we approach Christmas. So that's been a really nice relief here. But obviously in stark contrast to China, where there was some lockdown news over the weekend and a repetition from officials in China that they would be maintaining Beijing's very strict COVID controls. And that just allowed China stocks to marginally push lower, but they were bought and they were bid on the dip lower. It doesn't take very much good news to lift China's 50 shares now. And we just have to keep that in perspective that, you know, will China COVID zero policy be in operation in 9 months' time? Highly unlikely. So this does offer good value for medium, longer term buyers in particular. And you can see, you know, you look at China stocks, they have now, you know, if we just look at that, how far they've fallen. They have fallen, you know, around 50%, so just 45% roughly from the month of February 2021 highs. So, you know, looking at buyers coming back above that trend line would be a bullish catalyst. So, you know, if you're a little bit more conservative, you could wait for a push above that trend line and then go with it, looking for a run to 15, then 16, then 1800. That would make sense on China's 50. But the rest of the stocks are just being buoyed on that more positive sentiment news around the US midterm elections. I'll get to that in a minute, and we'll just have a tour through the markets to see what we're looking at today. Gold pushed lower, found some bids. The dollar's been sort of up and down a little bit choppy, similar with silver. Copper prices maintaining above that recent near-term overhead new with the China COVID potential pivot news just boosting copper prices. That's also been boosting oil prices. And taking a look at the yield space, we can just see yields pushing a little bit lower at the moment. That's more positive for stocks, and that pushes back against a little bit of that latest Federal Reserve narrative that there'll be a higher terminal rate. And that's what markets are really trying to get their sense of. Is the Fed going to pause, or is the Fed going to pivot? They have maintained their current state of play, but the midterm elections is taking the dominant driver in stocks. The dollar, little bit fractionally lower. That's just helping risk. Dollar yen just within that little symmetrical triangle pattern, and there is risk of Bank of Japan intervention as long as we sort of at any time we get up to that 150. We've seen a couple of instances of Bank of Japan Minister of Finance intervention, so look out for that as we move forward. Pound US dollar pair, pound euro, both been pushed and pulled around by the dollar, and there's a little bit of a divergence opening up now between the Bank of England and the Federal Reserve. So we'd potentially expect to find sort of sellers as we head up into this region here, with the Bank of England last week sort of indicating that they're not going to need to do so much now in terms of hiking interest rates. They're looking at the mini budget really on the 7th, not the mini budget, the budget really for the UK on the 17th of November, and expecting tightening to come from the budget rather than the Bank of England. So that's more bearish for the pound. We saw the pound's reaction to the Bank of England last week. And the Federal Reserve was more hawkish, with Jerome Powell sort of extending the terminal rate higher. So if you just take a look at the bond yield spread, we should see that tracking lower, and we do see that tracking lower. So with the yield spread pushing lower, that should indicate the pound US sort of find sellers around that kind of level. So you could look to manage define risk just around that 1.1550 region, and obviously the dollar is going to be a key focus this week as we'll look. So if we do see any reasons for significant dollar strength, i.e. high CPI, pound US dollar shorts make a lot of sense. So just bear that in mind. We've got this nice level here. If we get high inflation this week, pound US dollar shorts does make sense. Bond yield spread pushing lower, a bit of a divergence from the Bank of England and the Federal Reserve from last week. Okay, let's go. Where was that? That was gold prices. Yeah, okay. Now this is quite interesting for gold. Just bear this in mind as well as we look at the CPI print. Gold's just trying to push out above that long-term daily trend line. So if we get any reasons for significant dollar weakness, if we get like a big miss in the US CPI data, then gold running up to 1720 does make a lot of sense. And if that breaks, then we can look at 1760 to the upside as well. Now, what we're looking for here is we want to see anything that shows inflationary pressures are falling, and that would be negative for the dollar, negative for yields, positive for gold. So just keep your eye on gold. Gold trying to break out from last week above that near-term trend line. So just keep a careful eye on gold as we push forward into the week. Okay, now let's get to what's supporting stocks. Now, what's supporting stocks at the moment is recent polling over the US midterm elections. There's a couple of things to point out. Now, midterm elections tend to be quite strong for US stocks. And at the moment, according to Politico, they're forecasting, they're looking at a Republican House, and the Senate could either be Republican or Democrat. Now, if a Republican win either the House or the Senate, that's going to be bullish for equity. So at the moment, you can see with Republican likely expected to win the House, that is supporting stocks at the moment. And I want to show you how strong the seasonals are for the US midterm election. Now look at this. This is the US midterm elections going back to 1950. And what you can see is between like November the 20th and December the 30th, the S&P 500 has gained, whenever it's gained an average profit of 3.55%. Now, it's only lost value 3 times in those 18 individual years. And you can see the midterm elections, they come every 4 years. And you can see them, 1950, 54, 58, 62, all the way up to 2022. We haven't had 2022 yet. That's what we're now waiting for. So you can see generally, US midterms, stocks tend to do very well. Okay, so bear that in mind. Keep that seasonal pattern in mind. And if you look at this, saw this from All-Star Charts, and I'll just show you it from this perspective. Very interesting. Over 3 months, the average return for the S&P 500 after the US midterms has been 7.5% gains. And that has been 89% of the time. But if you extend that out to 6 months, 100% return since the 1950s and an average return of 14%. So if you have a longer term perspective or a longer term view and a 6 to 12 month outlook, you can see on average the return is 14% to 15%. So pretty healthy returns over a relatively short period of time. Now, there is a risk with this outlook, and of course, if the Fed have to keep hiking, if inflation remains firm, then these returns may not be so reliable. And just because the US midterm elections, it's gained 100% in the past, it doesn't mean it will gain 100% again. But nevertheless, it's something that you need to be aware of. Don't get carried away with the doom mongers and the fear people, because generally speaking, stocks move from lower to higher. So if you're constantly bearish on stocks, you're the wrong side of the market. Just bear that in mind, and it's difficult, when you're constantly being bombarded by different things on social media. And as long as you're defining, limiting your risk, using reasonable risk parameters, then you can manage that fairly soundly. So just keep that in mind. Okay, that is a good introduction to where we're at. It's all about the US midterm elections, and the sentiment is good. They're going to be released tomorrow, so watch out for volatility in stocks on that. Today, we have a number of Fed speakers. Remember, any Fed speakers that indicate some kind of pause is going to help boost the S&P 500 higher. So if we get, Fed's Mester Collins Barkin all coming out, making a case for either a pause or slowing rates or concerns about US slowing growth, look for the S&P 500 to gain. We want to see all three of them doing that. Got some Australian data overnight, not really expecting much. Really, it's the Tuesday, the midterm election results is going to take the majority of the emphasis. So on Tuesday, don't get sucked into anything else. Look how risk tone is impacted by the midterm elections. And as long as we're seeing at least one of either the Senate or the House having a Republican win, then that is positive for stocks. If it's a Democrat, either in the Senate or the House or both, that's negative for stocks. So Democrat in the Senate and the House, stocks fall. Republican either in the House or the Senate or both, stocks gain. Okay, that's the expectations of the market at the moment. That's what you should keep in your mind. Wednesday, inflation data, not much to expect out of China. The main news for China, we want to see some kind of pivot surrounding the China COVID zero policy. That's what's going to boost Chinese stocks. Inflation at the moment still fairly standard and not too much of a concern for China at the moment when you compare the inflation rate across the world. UK 10% plus inflation, so that shouldn't be much of a impact or mover. Oil stocks, remember, oil has twin drivers at the moment. Right, now let me just help you with oil. Oil, in my view at the moment, remains a buy on dips, okay? Because structurally, there's a problem with oil, and there isn't enough investment going on, there isn't enough development and research in drilling oil, new oil wells, and it's just not politically sexy, as it were, to say you're going to invest in fossil fuel and oil research and development. So it just means that the current supply levels are just not enough for the future anticipated demand levels. So I'm expecting oil to fight buyers, but whenever there's demand worries or concerns, you find oil dipping. Is China sticking to its COVID zero policy? That's all more negative on oil. But looking at those big term levels, big levels for buying on dips, this was obviously a key level that I've been highlighting around the sort of 84, 85 region, and we've seen prices moved in and pushed higher back up to that overhead resistance. So that would be a take profit area, but I still like oil medium term. So medium to longer term, particularly like say an oil ETF, I think that's very attractive. And if we get any reasons for weakness in the dollar, then more oil upside. Fed Barkin speaking as well on Wednesday. Again, the normal playbook. Anything dovish, anything about the Fed pausing, anything about concerns over slowing US growth, then that's positive for stocks. Negative for dollar, upside for the gold, precious metals, silver, and you'd expect upside for euro, US dollar. Thursday. Right, this is the main event of the week. This is what I'll be covering on the workshop, how to trade the US inflation print. This is the big one. Now, what are we expecting? Core inflation is expected to come in at 8%. Now, the prior reading was 2.2%, so that's a little bit lower than the prior reading. But what we're looking for here is if we have the, so this is the headline. What we're looking for is the headline and the core to both be lower. They're expected to be lower, so that's more dollar negative heading into the event. The best opportunity is going to come from a big miss. When I say a big miss, we want to see sub 7.6 for the headline, sub 6.3 for the core. If we get that, then I really do find gold and silver longs attractive. There are some demand growth issues for silver. There's a lot of demand coming out of India that's been pent up for silver. So silver upside in particular, I would find very attractive on a big miss out of this print. Sub 6.3, sub 7.6, that would be the one to look at. Fed Harker, Logan, George speaking again, the basic playbook, anything more dovish. If this is a big miss and then these Fed speakers start saying, okay, great, we can start thinking about slowing in, our rate of interest rate hikes, then that will be even further upside for S&P 500. And remember, if on Tuesday, say we get a Republican clean sweep in the House, in the Senate and the House, then that would be upside in the S&P 500. And if this is a miss, then that would be more upside in the S&P 500. So there is a chance here that we get a real good boost in US stocks, depending on what happens with the midterm elections and depending on what happens with the headline inflation. Main event of the week here, so don't miss this one. Expect volatility in the dollar, silver, gold, S&P 500. So bottom line, just to be clear, sub 6.3 for the core year on year, sub 7.6 for the headline, and obviously if we got sub 0.4 for the month on month and sub 0.3 for the month on month headline, that would be even better, and that would be upside gold, upside silver, downside dollar, upside euro US dollar, upside S&P 500, Dow, and probably NASDAQ. Governor Macklin speaking for the Bank of Canada. Just watch out for any signs of slowing down. We got, if say the opposite happens, say inflation comes in very strong, and this comes in like 8.2% plus, 6.7% plus for the headline, then expect exact opposite reaction. Gold downside, silver downside, dollar strength. And there, remember that pound US dollar outlook? So if this comes in hot, 8.2 plus, 6.7% plus, then I expect pound US dollar downside. And then if this comes in hot, but Macklin's more dovish, then I expect dollar CAD upside. So bear that in mind. We'll cover that again on Wednesday, so don't get too worried if you didn't pick that up. On Friday, it's consumer sentiment and inflation expectations. Some analysts really like the Michigan consumer sentiment data. They really like it because the consumer tends to be more responsive to changing financial outlooks than businesses. And that makes sense, doesn't it? Because you're much more sensitive as a household to the change in your income. If your income goes up, you think, oh, good, that means I can buy this, or I can buy that, or we'll do this as a family. And if your income goes down, you think, okay, well, we have to be more careful. We can't do this, we can't do that. We'll change the way we're budgeting this. So households tend to respond very quickly. Businesses, maybe they got longer term loans, and not everyone in the business necessarily knows exactly how the business is doing. Plenty of people work in business or companies and they have no idea on the financial situation of that company. So households are often preferred by some analysts because of that reason. So what we're looking for here is expectations for consumer sentiment for preliminary work for November. So this is quite soon. We're in November, and this is the preliminary result. So we would expect this to have an impact. If we see sentiment really dipping, so I'm talking sub 50 is what I want to see to really know that sentiment is dipping. And if you saw current conditions, sub 55, and consumer expectations sub 50, anything that showed that US consumers getting really worried, then again, you expect that to boost equities because it would mean that the Fed would be more likely to pause. You expect it to sink the dollar, you expect it to lift gold, lift silver, and you expect Euro US dollar to gain on that print. If it's a very strong print, we come in, above 60.2, above 65 for the current conditions, above 57.5 for the consumer expectations, then that means the Fed can keep hawkish, then that just is more the status quo. So expect that to pressure stocks, strengthen gold, strengthen the dollar, really, weaken gold, weaken silver, and you'd expect that to push pound US dollar lower. So that's really what we're looking at. Main event of the week is, from an economic data point of view, is the CPI print. The main political event is the US 2022 midterm elections. That's where the opportunities are going to lie around those events. Be careful, not getting just sucked in to trades unnecessarily. Try not to get just entering trades willy-nilly. Remember, sentiment at the moment is favoring the S&P 500 upside, because investors are just expecting the S&P 500 to be gaining as long as one of those parties wins. If we get like a forecast, political forecast that comes up and says, oh, the House is likely to be Democrat, the Senate is likely to be Democrat, then you'd expect stocks to start falling, okay? If we get a new update in the poll, latest polling, House Republican, Senate Republican, they expect the S&P 500 to keep gaining. Well, we covered an awful lot in quite a short period of time, so that's a good job that we've done there. And I'm just going to go over to any Q&A. If you've got any questions, please do ask the questions that you have. We have managed to make exceptionally good time. Forgive me if I've been speaking too quickly. Sometimes if I've really got through the information, I've been speaking too quickly. Okay. Well, I hope that's clear. There's a lot there. Don't forget you can pick up the recording. Don't forget to come back on Wednesday as well, and we'll get really ready for that US CPI print. Good opportunity with the CPI print, which of course we'll be looking forward to. And that could be a good opportunity for gold and silver in particular, as well as potentially stocks. Okay, folks, well, I do hope you have a very good week. Thank you all for attending. Yes, Stuart, the webinar is available later, and I would recommend you go and look at it. Particularly, sometimes I have to go quite quickly, and let me just, I'll show you where it is. If you go to, so first of all, make sure you're always going onto my blog here. I'll have an article up tomorrow on the midterm elections as well. Okay, I do keep this up to date with quite a lot of analysis. 95% of the analysis on here is my personal analysis. Okay, so that is the blog details. And then you also want to go to the YouTube. And if you go to YouTube, now bear with me here, Stuart, because I'm not very familiar with this channel. And if we just go to HYCM, and if we look at HYCM's channel, you should see this updated. Now, also remember, you can contact HYCM support, Stuart, at any time and ask for more specific directions. They should help you. Okay, accept that. Okay, so if you subscribe to HYCM, then you'll get the channel there, and you'll see the latest. So we've got seasonal insights, market mood, We've also got the trading webinars. So you get the trading webinars there, Stuart, okay? And you get the latest one. So that's the last one for trading the Fed meeting. All right, folks. Yeah, that's great, Stuart. What I'll do is I'll just send the link here as well, so you've got that. Okay, folks, thank you all very much for your time and look forward to being back here on Wednesday. Take care, everyone. Have a good afternoon. Goodbye.